Welcome back to another episode of Unpopular Investing, the channel where we look at stocks that are out of favor, ignored, or misunderstood, and ask one simple question. Is there an opportunity hiding in plain sight? Today we're looking at two companies the market has largely given up on, PayPal and Teleperformance. Both are profitable, both generate strong cash flows, yet both trade at valuations that suggest their best days are behind them. So the question is, are these undervalued opportunities or classic value traps? Now, first, let's start with PayPal. PayPal is down 77% in the past 5 years, as you can see, from its peak. Sorry, not from its peak, from $247 all the way till $56.88 today. PayPal stock fell sharply because the growth has decelerated after the pandemic. During the pandemic, this was one of those so-called pandemic darlings, which were loved by the market. Investors were paying very high multiples for it, and once they saw slowing revenue growth, they assumed the business was broken and that the best days were behind it. But what often gets missed is why growth has slowed. PayPal made a strategic decision to move away from low margin volume and focus on higher margin services, as well as more profitable customers and better long-term unit economics. And that hurts the short-term growth, but it does improve the quality of the business. So as we'll soon see, PayPal is a better business today than it was back then, but trades at a much lower multiple. Looking at the actual fundamentals, we can see that currently PayPal generates a cash flow of around 10%, a cash flow yield of around 10%, and that is around $6 billion. To be more specific, $6.563 billion per year. This is expected for 2025. And we can see that this is not a company that has stopped growing. Since 2015 to 2025, it has grown by about 5x, and it's been growing at a compound annual growth rate of around 10%, which is not bad and doesn't show a company that is slowing down. Now, even if we assume that PayPal's business is slowing down and it's only going to grow at inflation, say about 2 to 2.5% per year, then you're looking at a market-beating 12 to 13% annual return before any re-rating. And that's very simply the 10% free cash flow yield that they get, which they can use to do buybacks or to share dividends or acquire businesses. But this 10% free cash flow yield is being returned to the business. And then the 2 to 3% growth on top of that is just bonus, is just free growth, basically. And that's basically assuming that there's no multiple expansion, no major new growth drivers, and that their current growth rate drops from 7% to just 2 to 3%. And here we can see in the Q3 2025 financial results that they actually grew net revenues by 7%. And this is with other parts of the business accelerating. Their Venmo business grew close to over 20%, I believe. And let's not forget, Venmo is the leading peer-to-peer payment provider in the US, and it's owned by PayPal. Venmo has even become a verb in the US. You say, let me Venmo you that money. So it's kind of like Google. Google has become a verb as well. And that's how you can tell that a company has built a very strong brand in the market, which is also worth something. Now, let's look at other catalysts, because their growth has slowed down and there is a risk that it slows to 2 to 3% if they do nothing about it. But the fact is they are doing something about it. And here we'll see what initiatives they have according to Google. So the first initiative is PayPal Everywhere. It's basically a physical retail expansion. They want to expand their branded checkout in brick and mortar environments. Right now, they're very strong online, but they want to go beyond that And this would also increase their addressable market as well as their margins, which is really positive. Another initiative is Fastlane. It's basically a one-click guest checkout designed to reduce friction for the users. So when you go to a website to make a purchase, if you've already paid with PayPal before, then it already remembers who you are, and the checkout is so much easier. What that does as well is it is kind of building a moat, because if many consumers start to use the fast lane checkout, it's also in the benefit of the business to enable fast lane checkout if many people are registered with PayPal. And right now, PayPal has about 400 million active users. So they definitely have a very strong starting point here and a very powerful proposition, because what the business gets from this is not only a smoother checkout, but they get very interesting insights on consumer behavior. Another one is AI-driven commerce. They're the first company to get into payments for agentic AI solutions. So they are partnering with ChatGPT, Google, Apple to enable payments for agentic AI. And this market is massive and set to grow massively in the coming years. So if they can even capture a small share of this sector, then they have massive upside as a result and massive growth in the coming years. And they are the first mover here, so that's something very important to remember. Another thing that they are also working on is advertising. Amazon added advertising to their platform, and it drastically increased. It became a very fast growing part of their business because people really want visibility on Amazon, and it is the biggest retailer. PayPal is one of the biggest payments platforms, and companies might be interested to advertise and push their products as recommendations to consumers through the platform. So that could be also a growth driver. Another one, which I briefly touched on, is Venmo. Monetizing and expanding Venmo would be huge. Meta did that when they were dropping and everyone was hating on them for the metaverse. They monetized WhatsApp, and this was one of the initiatives in addition to the cost cutting initiatives that they did, which helped with their turnaround. So this could really boost margins for PayPal. And Venmo, as I mentioned before, is growing close to 20-30% a year, which is massive growth. And as it becomes a bigger part of the business, it will lift the overall growth of PayPal in the coming years. Another initiative is PayPal World, which aims to simplify international transactions. And this is a big thing because international transfers usually take several days at least to happen. So yeah, this is playing on the future of the digital wallets and crypto and all that. And yeah, PayPal is also getting into that area, crypto. They have their own stable coin as well, which will earn them interest as well. So if people hold their money with PayPal in the form of stable coins, they can earn interest on that money and also pay out an interest. They also recently got licensed as a bank. So this will enable them to grow their margins and also grow the financial offerings that they can have, because some offerings are very restricted and PayPal has to rely on other banks for some of the financial services they provide. But with them being a bank and having that banking license, that could really expand the amount of products that they can offer and the role that they play in the financial ecosystem, potentially generating further growth. Another thing is strategic partnerships. I mentioned before, they're partnered with Apple, PayPal. So one of the big theories for why PayPal is dropping is because they're facing increased competition. But what PayPal is actually doing is partnering with their competitors, potential competitors, let's call it, such as Apple and Google, to enable a smoother process and to just enable their services throughout different platforms. Another thing they've been focused on is financial and operational efficiency, and they have been using this money to buy back shares really aggressively with a $15 billion program. So the cash flow yield we saw earlier is not only a theoretical amount that they could spend on buybacks, they're actually spending all their cash flow and more on buybacks, which really signals that the business sees the value in the company and in the future of the company as well. And this, for me as an investor, is a very positive sign that the management sees the value and believes in the business in the long term. So yeah, here you have the different growth numbers. I understated the Venmo growth. It's actually over 40%. The buy now, pay later, which they have, is over 20%. That's another fast growing part of the business. And the branded checkout, which has higher margins than the faster growing unbranded checkout, is around 8 to 10% growth by 2027. So actually, PayPal expects to grow the business, to accelerate its growth and grow at 10 to 15% in starting in 2027, I believe, which add to that the 10% cash flow, and you have a yield of 20 to 25% on your investment. That's a double in 4 years, 4 to 5 years. Sorry, 3 to 4 years actually, because of compounding. So that's an incredible return. So yeah, not the dying company that you would expect. And certainly if they do achieve their growth expectations, then this is going to get a re-rating, and the multiples are going to change from the current 10 PE to potentially 20 or 30 PE, which could lead to a drastic gain in the stock price. Now, let's move on to Teleperformance. So why does the market hate Teleperformance? Teleperformance currently trades at 58, and 5 years ago it was 285 euros. This company mainly does customer service, so they're an outsourcing company, and a lot of the thesis for why this stock has been underperforming and why their growth has been affected is because of AI taking customer service jobs, and companies don't need customer service anymore because they have AI, they can do chatbots. But the AI hype around chatbots has been overstated. And if you think about it, who is best positioned to take advantage of developments in chatbots and improve and elevate their customer service? It's actually companies specialized in this area, which Teleperformance is. And as a result of that, they have been investing and taking a lot of steps towards integrating AI into their operations and elevating their experience. And that comes with a cost. So they've been investing in this improved experience. And that's why we see continued drop in the stock price, because it's unclear to investors if these investments will generate a return and if it will work, or if Teleperformance will lose business in the coming years. And that's why it's been priced at such a low multiple. If we actually look at how much they generate around $1 billion of free cash flow, and their enterprise value is around $9.5 billion most recently. So that's about 11% cash flow yield, which means a return of 12 to 14% if they only grow at the current rate of 1 to 3%. If they actually accelerate their growth, then you could get much more than that. But with a conservative assumption that they aren't able to turn around the business, but are able to maintain their current growth rate at least of about 1 to 3%, then you could expect 12 to 14% from this business. And they've already started increasing their their stock buybacks. Now, of course, every business has its risks. And with this business, the risk is very clear. If they aren't able to increase competitiveness and they get more competitors because of the ease of creating chatbots or just smaller customer support businesses popping up, freelancers, companies going in a different route, then of course that could cause them to start to lose business and contracts. And then that would affect the business negatively and the stock might drop even further. However, I see that as very unlikely. They are the most well positioned to take advantage of the change happening in the sector. And right now, the market isn't pricing that in. So if the market changes its view on this company and on the sector in general, then this could have a lot of positive price appreciation. Now, one thing to keep in mind is the reason a lot of these stocks right now are trading so cheaply is also because people are upset, or investors are currently obsessed with companies that are growing very rapidly and have incredible momentum. The big names, the AI names, the chip manufacturers, all the fun and fancy stuff that's out there, Nebulous and all these different companies that are taking the headlines, even Google with its when coming out with new chips and all that. But nobody's paying attention to these slow growers that could accelerate in the coming years, that have low downside and very high upside potential. So with that, I think that these valuations aren't bad. This is not financial advice, and definitely do your own due diligence. And if you like this video and you want me to do a further deep dive on PayPal or Teleperformance, or if there's any other companies that you'd like, please leave a comment and also leave a like if you enjoyed this video. Thanks for watching. See you next time.